that they're
going
going
right
to
out
see
the
the,
door.
the tightenings's already done
Perfect.
damage. The
So we
economy's
got
already
Mr. David Hunter back on. Last time we
over,
talked, I think,
and
was
they're
in
smart
what,
enough to
December.
know
So
they
welcome
can't
back.
let
Good to
that
have you
go,
again.
or else. Yeah, thanks, Eric. Glad to be back.
So we were talking before we started just a little bit about the stuff that's going on in, Ukraine and Russia, which is just a very fascinating start to 2022. We were just talking a little bit about how that's looked so far, but one of the things I'm curious to dive into, dovetailing off of that initial conversation, is how does that impact the markets in your eyes? There's a lot of things that obviously Russia contributes, natural gas, things like that. Just curious from a broad perspective, what does that look like to you, and how does this play out throughout the rest of the year?
Yeah, for sure. I mean, they've certainly pushed commodity prices up higher. Oil obviously had the spike, and it just creates a lot of uncertainty, which markets don't like. The amazing thing is that almost to the day that Russia invaded Ukraine, the market started rallying. So, I mean, this is a classic example of sell the rumor, buy the news, and basically, I think there still is plenty of uncertainty, but I think the market was able to wrap their arms around the fact that we kind of see what this is going to be. Barring some unforeseen thing that drags us into some kind of a world war, I think they pretty quickly kind of surmised, yes, we can deal with this. Yes, it's going to cause an inflation spike and cause, some shortages, et cetera. But, markets are pretty amazing in terms of kind of discounting things very quickly. And I think that's what they've done. Unless this thing really escalates again, I think you've seen, the effect of Ukraine and Russia already. And now the big thing is if they can get a negotiated settlement, and I by no means say that's a given, but if that happens over the next month, next few weeks, I think you will see that will help the markets. Even though we've rallied since they went in there was plenty holding the market back in January, February, prior to the rally that I think had something to do with the risks in Ukraine. So I think if we get Ukraine resolved, and it's some sort of a solution that looks like it can last, I think that will take us up sharply to maybe to my targets.
Interesting. And it leads to kind of a follow-on question. So, and you alluded to some of it, being the quality of the peace talks, but is there a scenario where you think, Russia and Ukraine have these peace talks and the market doesn't like the outcome? What kind of thing would have to happen for there to be a negative reaction to that, in your opinion?
Yeah, it's I think anything short of dragging NATO into this, probably the market has handled and discounted.
Got it.
If it becomes something that widens to the point where it looks like the U.S. is stepping in or NATO is stepping in, that is something I think the markets would be shaken up by. And certainly possible, but at this point doesn't look like the most probable scenario.
Yeah. And then the other just last part on that, out of curiosity, do you think the markets, or how do you think the markets would react to China potentially interacting? Because obviously we've been talking about the U.S. interacting with Russia and Ukraine. There's been some back talk of China, but I'm just curious, your thoughts on that.
Yeah, my sense is China is smart enough to know that they'll support Russia in kind of subtle ways or in back channel ways. They're smart enough to know an awful lot of their bread is buttered by U.S. Dollars, and
yep.
And do we want to jeopardize our economy to support a situation like this? I think they're probably if they didn't have to worry about that, they'd be in there probably very supportive. I think they're trying to walk a line right now. Clearly, they're cozying up to Russia. Russia's cozying up to them, but they're still trying to appear like they're not pushing this. They're not vocally against it, but they're certainly not coming in with both feet and saying, yeah, we're here with you, Russia. So I think they understand. We have some leverage over them too.
Yeah, and I think that's one of the things I was actually talking to a couple of friends about is there's a saying, I'm sure you've heard it, the enemy of my enemy is my friend. And, right now, US isn't necessarily the first pick for either Russia or China in a broad sense, in terms of alliances and whatnot. But it does seem like China's in this very precarious spot because I know that our economies are so intertwined. And I find that to be such a interesting add-in to defense measures. We're talking about one country invading another and then the global stance against that. And then there's still this backdrop behind it. Just for my own edification, if China did decide to back Russia more openly, personally, I don't see that really happening. But if it were to happen, what kind of, follow through do you think we would see across the economy and just the marketplace at large?
Yeah, it would certainly indicate that China was becoming more aggressive, and not sizing it up as what's the economic cost to us, et cetera. And they're basically, I think they'd be becoming more open about their alliance with Russia. I mean, we all know, two communist nations that are much closer to each other than they are to us. But
right.
I think they still want to appear to be that country that is not the aggressor, that is, yes, they're building a strong defense, and yes, there are signs that they're getting more aggressive. But I think that would be a crossing of the line that the markets would take that pretty negatively.
Yeah.
The other big issue with all of this, obviously, are the sanctions and the fact that we're kind of, pushing these large countries and countries that do a lot of world trade away from the dollar. And, we're really not necessarily, I'm not sure if that was all well thought out in terms of when they took the last steps. They're really, you're seeing, obviously, Russia's backing the ruble with some sort of a gold backing, and China's, I think, celebrating the fact that the dollar is becoming, under fire a little bit here, and that some settlements, even Saudi Arabia is talking about settling, oil contracts in China in yuan. So, I mean, I think we are seeing some fallout from those sanctions that I think are not necessarily the smartest things we could have done. But, again, the market seems to be handling it. So it's more, I think that's more of it may speed up an inevitable thing that was going to happen, that the dollar is going to lose some reserve status down the road. I continue to say I think it's farther down the road than some of the bears think. I think you're still probably several 5 years away from anything that really impacts our leadership as a reserve currency.
Yeah, and it's funny because that was the follow-on point I was going to ask you, especially as it pertains to the SWIFT banking system and some of those impacts. Do you think that if, Russia and Ukraine come to a peace agreement, do you think that those sanctions will be backed off? And if so, what would the impact to the market be in that scenario? Or do you think the sanctions would remain in place and kind of tailor it off over time?
Yeah, I think it's going to be probably reduced over time. I think we'd be foolish to accept any agreement and swallow the whole thing all at once as if we can trust Putin. We really can't.
Right.
However, I do think it'll probably be part of the settlement, is that there will be certain give and take on the part of NATO too. So I would think some of those sanctions will be pulled away, and some left in place and pulled away slowly. I would think the SWIFT situation would be resolved early. I don't know that, but I would think because that hurts everybody. So
right. Yeah, it felt like at one point it really did feel like Putin was kind of playing chess while we were playing checkers. I don't know if you saw the video that he put out. He had a fascinating video. I'll throw it in the link to the video here for people who want to check it out. And I'm paraphrasing, so definitely check out the source directly. But It was to the effect of, this is why we can't trust the dollar, because they choose to do things like this. And it's, you look at that and you're like, the guy's not wrong. You know what I mean? Like I could see a lot of people look at that saying, well, yeah, how safe is this if they can just choose to react like this? And I was kind of, it's like, well played, because that's a really effective line of thought.
If you really think about it, in the last several years, we've chosen to say, particularly with Russia, we've chosen to say, rather than get into any kind of armed conflict with these guys, we're going to throw our weight around with the dollar and with our economic weight.
Right.
And, we're going to sanction and hurt the oligarchs, et cetera. And he probably had calculated some of this ahead of time in terms of saying, I think we can get them to move and actually in the long run hurt themselves here. So we'll see. But I don't think what we did is without risk.
Yeah, I think that's literally a perfect characterization there. So that leads, you were talking a little bit about your forecasts. How could we not talk about those? So, last time we were talking in early December, you were messaging about the melt up. You obviously had your levels in place there, and then preceding global bust of some sort, potentially to the magnitude of, an 80% drawdown. Obviously, things change and new information comes in. So I would be curious just to get an update on that. I've seen a couple of your Twitter posts, but obviously I always enjoy hearing the, the overall thought from you directly. So I'd love to hear, just from a macro standpoint, what are you thinking about the markets here?
Yeah, the forecast hasn't really changed. I still believe we're going to see a melt up to 6,000 on the S&P, 20,000 on the NASDAQ. Actually, I should say, since we talked in my January letter, which came out the first week of January, I did raise my target. So my target, I think, in December was 5,300 S&P.
Yeah, I think it was 53 or 55.
18,000 NASDAQ, and I'm now 20,000 NASDAQ, 6,000 S&P.
Got it.
45,000 Dow. Which had been 42, I think. So I definitely got more aggressive on the upside. Okay. My 80% bear market and global bust has not changed at all. If anything, it has stretched out a bit because of Ukraine. The correction in the first couple months of this year, I actually forecasted that. But what I obviously didn't know back in December was that we were going to have, the Russia invade Ukraine. So that has probably changed the timing a bit, not a lot. I was kind of saying we could see the 6,000 S&P by mid-year this year. And that's still possible. I'd say more likely it pushes it out into the summer further. And the bust is probably a fourth quarter event. And again, not that it all happened. Like, people on Twitter will go, well, you're talking about 2023 now. And I said, well, it starts in 2022, but it's a year-long process. You don't go through a bust, which is a severe economic downturn, in a couple months. It's not the market, it's the economy. So it'll probably start later this year, maybe fourth quarter, and carry through at least mid-year next year, maybe much of next year. It's going to be, in my opinion, the worst downturn in the post-World War II era. So, worst downturn since the Great Depression, but not a depression, not something that lasts over many, many years, but rather something that probably is contained within about a year. And then the bear market, peak to trough is about 80%. Again, we haven't seen anything like that in the post-World War II era. Last time, I think we were down 60 some odd percent in 2008-9. So This is worse than that. And I think a lot of the problems are global, are outside the US. So whereas 2008-9, our banks were really the ones that took it on the chin and were in the worst shape, this time around, our banks kind of got religion because of what happened in 2008-9. And the real problems now are more, the European banks are in rough shape. particularly after what's happened in this first quarter of this year with Ukraine. And the Canadian banks are not, they were much more pristine back in 2008-9. They're more like we were then. They're kind of extended. Australia's got some issues. Their real estate's through the roof. So you've got, I think, lots of banking issues and financial issues that are outside this country. So people have to remember, this is, even though my focus is U.S., this is going to be a global bust. It's not just the U.S.
Obviously, a ton to unpack there. So going into the overall flow of the market, kind of this melt up and then a bust, from a secular standpoint, what do you think leads the melt up, and then what do you think leads the bust?
Yeah, the melt up is, I've said for a long time, I believe this is the culmination of a 40-year bull market. So in August of 1982, the Dow was at 786 maybe, and is now in the mid 30s. So it had a huge run in the last 40 years. S&P and Dow and Nasdaq, same thing. Huge runs, driven by the fact that we went from 15% long bond, 15% 10-year, 20% T-bill rates, 21% T-bill rates back in the early 80s. And we took it all the way down to last year. We were at 40 basis points on the 10-year and basically zero on short rates. So that big drop in rates over many decades was the wind at the back of the market, because that just pushed PE multiples, price earnings multiples up. We're at the point now where, not right now, but within the next year, we're going to probably bottom out rates for the cycle, meaning for the last 40 years. And PE multiples will be going in the opposite direction. So
it's funny. So yeah, not to throw you off, sorry. Two of the things you just mentioned, I just had a couple charts, that I pulled from long-term trends. But anyways, this top one is PE ratio, just as you were talking about. And then this bottom one looks at the S&P 500 index to the total bond return index. So kind of two trends that you were talking about, just visualized here, where we're seeing, sorry, go ahead.
Yeah, I said, sure. Yeah, the rates coming down pushes stocks higher, all things being equal. Obviously, you have periods of recession where earnings go down. So even though rates are low, stocks go down. But overall, it's been a secular bull market since 1982. I think it comes to an end this year. And I think the last leg of that bull market will be parabolic. So you could argue we've been in a parabolic melt up since 2020, since the March lows in 2020. It's been a hell of a ride. It was a doubling in the market off those lows. But this last leg, which I think begins probably in the next month, will take the S&P up to 6,000, maybe higher than 6,000 even, not a lot higher, but it could go higher than that. And will be pretty straight up. It's going to be a very vertical rally. So as steep as the run has been since March 2020, this last 2 years, this last run is going to be steeper. So it means you cover more ground in a shorter amount of time, type of thing. So a steep slope. And basically, I think it's a little hard for people to understand why, when we're staring at a Fed that's talking about 6 or 7 hikes this year and pulling money out of the economy, shrinking their balance sheet, it's a little hard for people to grasp why that would be bullish. And all I can say is history tells you that as the economy slows, and I think we've already done, I keep saying this, the bond market has done the tightening already. Everybody's acting like the Fed is just starting a tightening cycle. I think we're coming to the end of the tightening cycle. The bond market did it over the course of the last several months. We've got an inverted yield curve, can get a little bit more inverted, but I think given the fragility in the system because of the pandemic, and given the leverage in the system that's been building for decades, I think this economy can can be hurt much faster by rising rates than would be normal. So in other words, a slightly inverted curve might not have had the same impact in the last cycle or the cycle before that. But I think, given what's, the fragility that's been built in by the pandemic, that this time around, that is enough tightening to really send things negative. And I think the surprise may be that we'll see negative GDP in the second quarter, and that the Fed will look at that and say, hey, maybe we can't do all these hikes that we're talking about. The other risk, what I'm hearing lately, which I think could be part of the story for the bust, is you're hearing the Fed talk about, some Fed officials anyway, talking about, well, maybe we'll pause on rates at some point, we'll hike for, a little bit here, but that, maybe we shouldn't focus on rates. Maybe we really need to kind of shrink our balance sheet a little bit, bring that back down into a more normal period. I'm a monetarist, and I can tell you that's the message I would not want to hear, in terms of that could be what really brings on a bust. You pull money out of the system and you're going to see it's, for some reason, an awful lot of economists think interest rates are the key. I think money's the key. And if you pull money out, you're going to see it reflected in a much weaker economy.
It's interesting. Do you think that might be why Jerome Powell's been messaging so hard around interest rates? Because you bring up a good point. They did bring up, potential tightening of their spending, but it always seems like that's, I wouldn't call it secondary, but not the primary focus of their conversations. They really seem to be centered on rates. Do you think that's on purpose to try and steer the thought process a little bit, or just curious what?
Yeah,
what
no, I think forever, for as long as I've been a Fed watcher, which goes back to 1973, interest rates seem to be the focal point for most economists and for the Fed typically. And they do mess around with the balance sheet. They do understand, pumping money into the system or pulling money out is tightening or easing or tightening. So that's not new. And I don't think he was trying to, I don't think what we're seeing is anything different. Just remember, we've had a balance sheet grow to $9 trillion from, 3.7 trillion back in March 2020. So it's grown $5 trillion. And so, of course, and in 2008, October 2008, it was 875 billion. So we've gone up, $8 trillion from there. So we're looking at money in terms of the balance sheet of the Fed at levels that nobody could have ever fathomed just a couple of years ago. So of course they're saying maybe we need to rein some of that in. We did a lot of that because of the pandemic and all the the things we were worried about. So I think that's normal what they're doing. It makes sense. I just worry that we may find out, and I use that word fragility a lot, we may find out that the economy is just not resilient enough to withstand even a little bit of that kind of tightening of money. And same thing with rates. Normally when you got inflation pushing 5, 6, 7%, normally you'd expect to see rates pushing 5, 6, 7% to rein it in. And I don't think this economy can withstand much beyond where we are. So, I mean, I think that's what's different this time. And those are dangerous words, but I really think we are a much more fragile system, and fragile means we can unwind much faster and surprisingly, and in a surprising way that, we just don't have precedent for.
Speaking of not having precedent for, what do you think about, you mentioned it already, but I wanted to talk about it explicitly. What do you think about just the overall leverage that we see in the markets right now? Obviously, there's a bunch of different metrics out there that tie to the essentially leverage right now being at untold levels before. Do you think that plays into your rapid meltdown / bust concept, or does it draw things out potentially if they start unwinding earlier and bringing leverage down? Because we saw a little bit of that too with real margin debt plummeting a ton, essentially from late 2020 into this year. So just curious what the role of leverage, in your opinion, has into your forecast.
Yeah, I mean, it's key to my forecast. My whole definition of bust comes from the fact that we have, as I say, my equation is massive leverage plus fragility in the system equals bust. I mean, you basically, we're off the charts. There's no, even 2008-9 didn't have the leverage we have today. And I used leverage. I define leverage as two things. One, the leverage of the economy, which is debt. We've got 300 trillion. By the way, we've gone from 250 trillion in global debt to 300 trillion in 2 years. We've added 50 trillion because of the pandemic. That's a huge jump. And so we've got 300 trillion in debt, and then we've got quadrillions in notional value of derivatives, and derivatives are a form of leverage on markets. Yep. Whether they be fixed income markets, whether they be equity markets, there's so many different derivative products out there, and an awful lot of counterparty risk, et cetera. So what leverage is just very much added risk to the system. When you have massive leverage to the degree we do, it's just much higher risk. And so I do think, in business school, you learn that leverage on the way up can enhance returns, and on the way down, it really exacerbates the losses. So what I think we'll see is that you're not going to reduce leverage in any meaningful way deliberately. Margin debt's a different story. Margin debt, when markets correct, some margin you see some turnaround in margin because it's pretty quick. You get margin calls, you get, that stuff gets liquidated quickly and reduces the margin. So you did have a step down. But in the overall debt, the way that gets liquidated is involuntarily, right, in downturns. So, and that's what makes downturns so bad. I mean, that's why a downturn can turn into something much worse when you've got this kind of leverage on the system. So I do think you're going to see a lot of involuntary debt liquidation during this next down cycle. But it won't be, unlike a lot of strategists and economists out there, I am not saying this is the high water mark in debt. I believe the high water mark in debt will be much higher than we are. If we're 300 trillion today in global debt, I believe before the end of this decade, we'll probably be closer to 450 or 500 trillion. And the reason I can say that is because I think the response to the bust, keep in mind, I'm talking about major bank failures, major banks in Europe and wherever else, Asia and Australia, Canada, wherever, major bank failures coming at you all at once. There's only one tool they have to deal with that, and that is to print money like there's no tomorrow, and combined with massive fiscal expansion. So you get a lot of what you saw in March, April of 2020. You'll get that times, times 5, times 10. So
I don't know if the printers can handle that.
Right. Well, no, I don't know if anybody's going to be able to handle this, but it's the only thing. It's the only game in town. If they wait, if they say, okay, we're gonna sit and deliberate, we're gonna go to Congress and let them figure this out, the system will be bust by the time you get something figured out. I mean, they moved pretty fast in March 2020. The Fed certainly did, and Congress came along behind them fairly quickly for Congress. Yeah. But when you got banks failing and one after another in a domino effect, you don't have time to say, let's deliberate and figure out what policy makes sense here. All you can do is shove money out the door and hope you can stabilize it. Now they'll do what they can to declare moratoriums and what have you, but it's going to be money times 10. I mean, that's why I say we could see a $30 trillion Fed balance sheet by the time we get to 2024.
It's wild. That's
So,
wild to
and,
even conceive.
and so what that does is that just sets you up for, you know, problems down the road. It's not that it fixes anything. It postpones the, you know, the reckoning day.
So do you think that's the game plan here? Because again, like, I think it's always easy to look at what the government in general at large is doing to solve problems and poke holes and say, you know, there's a better way to do this here, a better way to do that there. I assume the Fed is wise enough to at least perceive some of the proverbial kicking the can down the road. What do you think their game plan is here? Is it just to kick the can down the road as long as they can, postpone it until the bust inevitably occurs? Or do you think that they're hoping that there's a solution along the way?
Yeah, I think they are doing what they can within their models. I mean, they get data every day, and they're looking at, you know, when they have their meetings, they're looking at reams of data, and they're trying to read the tea leaves like everybody else, like every economist, and try to figure out what's the path we're on, and what do we do to make sure we don't, you know, fall off that path or, you know, make things worse. So they're legitimately trying to do the right thing. I know they have lost credibility with a lot of people, and, you know, there's plenty of critics out there, but frankly, if you were in Powell's shoes, you can only do so much. I mean, you can't say, hey, let's just throw this model away and start over. You can't do it. You know, as I say, if you did what the Austrian school recommends, we'd all be living in caves. I mean, you can't just say, let's go on a gold standard or let's do something to put discipline in the system. You got to deal with the cards you've been dealt. And the cards we've been dealt is massive leverage, you know, an economy that now is showing inflation breaking out, et cetera. So what they're trying to do, and they are a consensus building operation, you know, their committee is, you know, they work, it's not like one guy dictates, it's the whole committee. And what they're trying to do is sort out all the data and say, okay, how can we kind of bring this down in a way that's not going to disrupt everything? So that's why it's kind of the gradual as you go, quarter point hikes, maybe a half point hike here or there. You know, that's all nice. I just don't think they're going to be able to live that out. You know, I think ultimately things are going to change their expectations, but I have no doubt they are sincerely trying to do things right. By everybody. And they've got to balance unemployment or jobs and inflation. And right now inflation's kind of, you know, and we've got center court and everybody's paying attention to that. And they're hearing from lots of constituencies that, you know, you've got to fix this inflation. So that's kind of taken precedence a little bit over, you know, worrying about the economy. My forecast basically is based on the fact that I think within the next few months, the economy is going to take precedence again.
We're back at it. Small technical difficulty, but we worked through it. So conveniently, we are coming up on time here. I definitely don't want to overkeep you. You got family, and that always comes first. So there's two last things I wanted to talk to you about quickly. The first one is when I think about your forecast, kind of this melt up and bust concept, I see a lot of varying strength and weaknesses across different sectors. And I'm curious if there are any sectors in particular that you think will lead the melt up, and if there are any sectors that you think will lead the bust. You mentioned banks, financials before, but I'm curious if you have any specific thoughts on those.
Yeah, first, for the melt up, I think it's going to be a very broad melt up. I know for a lot of people, they've kind of been told and are believing that we're going to see a very narrow market. Any rally that's left is narrow. I think we're going to broaden out here. So I think a lot of things are going to play. Growth is going to play. Value is going to play at the same time. Large cap's going to play. So is small cap. I think the Russell can go to 3,000. So that's, you know, that's a big move from here. I think you're going to see, you know, the big cap tech, you know, the FANG stocks do quite well. I think you're going to see small cap tech, you know, the Kathy Wood type stocks do okay, maybe do quite well. I think industrials are going to play for sure. Commodities are going to continue to play. I think you're going to see some of the early cycle things like autos and airlines play as we, focus on the fact that the economy is reopening and
Right.
this new Omicron strain isn't shutting anything down, and actually we're opening up. So I think it's going to be a broad base. The areas that probably will lag will be defensive. So utilities and maybe staples. But otherwise, I think the cyclicals do very well. I love semis. I think semis will do very well. Again, it's not straight from here. I think we've had a very nice rally in the last 3 weeks. So you could see, a pullback here of, 5 to 10%, depending on the sector. And I think, the semis and the fangs will pull back with everything else. So, but then on the other side of this, once you get to the top with an 80% bear market, you're going to see an awful lot of things get hit. So it's going to be broad based on the other side too. I don't know that anything is going to get hit worse. If the indexes are going down 80%, pretty much everything's going down and going down hard. The one thing I would say is that, tech is so overowned, particularly the FANGs and the Microsofts and the big cap that have been, the ownership's been built over many, many years. I think we're at the top. When we reach this top, it's the top of that cycle for those stocks, and they will not be leaders in the next cycle. They will be laggards in the next cycle. So they're going to get hit hard in the bust along with everything else. The big story of the next cycle is going to be an inflation cycle that will favor value stocks and, everything from energy. I think it's a huge commodity cycle. So everything from energy to metals, to agriculture, and the things that will lag will be the winners of this cycle, which would be, your FANGs, your growth stocks, healthcare. Those things I think are going to be laggards in the next cycle. So just understand, once we go through the bust and the bear market, coming out the other side, it's a very different cycle than the one we've just come through.
Huge point right there. And I think that's like a very important nuance to your forecast, because I think at least most of my generations, the millennials, we've just seen tech. That's really what we're so used to seeing skyrocket. Tech goes up and other things sometimes go up. So that's I think a very interesting call out there. Do you think that it's just because they will become so overvalued, they won't be attractive anymore? Or what do you think leads tech to not necessarily participate?
That's a great question. And the real answer to that is the next cycle, with inflation going from basically negative, I'm calling for a deflationary bust. So as much as inflation's on everybody's, it's the talk of the town right now. A year from now, we'll be in deflation, in my opinion, because of how bad the economy gets hit globally. So it will be a short-lived deflationary cycle, but we'll be in deflation. I think the 10-year will be down at 0% 10-year. I think we're peaking right now in the 10-year at 2.5, could go to 260, but not a lot above that. We'll be at 0 in the bottom of the bust. From there, I expect the 10-year to go to 15% before the end of the decade, 30-year to go to 15%, treasury bills to go from negative rates probably in the bust up to 21%. That's a retrace of 40 years of declines in rates. If you have rates moving up that dramatically, and it's not going to be right away, but over the course of the decade, that's, as I said, rates coming down was a wind at the back of the market. That becomes a headwind, a fierce headwind that shrinks PE multiples. So growth stocks depend on multiple expansion. Yep. They're growing steadily, and what moves them is the expansion in their PE multiples. Whereas value stocks, cyclical stocks, depend on big earnings spurts. When the economy gets going and they're in favor, they can have big runs in earnings. So you're going to need to be in stocks that can outpace that big jump in interest rates. That's commodities. I think oil is going to go from, I think oil can fall down into the 30s, maybe even into the 20s during the bust from where we are, $100. But in the next cycle, before the end of the decade, I expect oil to be at $400. That does a lot to earnings for oil companies.
Oh,
so
man.
Oil companies will have tremendous earnings. That's what can outpace the big jump in rates. I expect gold to go to 10,000, maybe 20,000, silver to go to 400. Those are the kind of price moves that can outpace inflation. What that generates in terms of earnings is where you're going to make your money. If you're in an index fund, you get squeezed because interest rates are going up. You're not going to have multiple expansion. The reason indexes did so well, the reason people could put their money in an S&P, back in 1982 and just ride it for 40 years is because interest rates came down. If interest rates reverse and go the other way, it works opposite. Index funds are not going to be a place to be. So the next cycle is going to be, for a lot of people, they're going to have to learn to understand a different cycle.
Yeah, and that leads actually into just a quick follow-on question there. Do you think things like cryptocurrencies and stuff like that change the role of gold going forward? I see a ton of conversation about that. I personally think that there's still two different things. And a lot of people think that cryptocurrency is ready to be like the new gold. I have a hard time conceptualizing that, but be curious your thoughts.
Yeah, that's certainly a popular narrative out there. I'm not in that camp either. I think gold and silver and the precious metals will be in favor again in a big way, and in a cycle unlike any we've seen. And crypto's not going to hold them back. It was a narrative that fit because gold went, peaked out in 2011 and went sideways to down for 10 years, more than 10 years. So people were trying to figure out why, and crypto was doing well, so it must be crypto. Well, that's not my belief. I don't think crypto is going to stop the move in the metals. And I think what I've always said, I don't follow Bitcoin or crypto, but what I always say is, let's see how it holds up in the bust. It's never really been tested in a down cycle. Let's see what it does in that period. It's easy to like it when it's going up. We'll see what happens when I think most assets are going to be going down, including crypto.
It's a good point. It would be kind of an interesting observation. Okay, one last question, as I promised to get you out of here on time. What are you looking at for the rest of 2022? What kind of things are you keeping a close eye on that inform your analysis of, your forecast, essentially?
Yeah, well, sentiment plays a big role in my forecast, and right now, obviously, we've had a 10% run off the bottom in the indexes. So short term, I think they may be ahead of themselves, and we may not be out of the woods in terms of the worries about what the Fed's going to do and inflation, et cetera. So there's room here in the next 2 or 3 weeks. It's not a long move, but I see a setup where you could see the S&P down 6 to 8% and the NASDAQ down 10% from these levels right here or close to here. But then I do feel that meltup probably carries us into the summer, maybe through the summer. I don't know. But something between 3 and 6 months is what I kind of expect for the rally to be. And like I said, it could be 6,000, it might be 62 or 300, but somewhere in that range on the S&P. And I suspect at that point in time, I get told I'm crazy with my meltup call. At that point in time, I think I'm going to be told I'm crazy to be talking about the other side. People are going to be all in. You're going to see the sentiment will have shifted from, what it was a month ago. The sky's falling, we're going down. We've seen the top. I think at 6,000, everybody's going to be telling you how there's many years to run in this bull market. You got to get in, and that'll be a sign of a top. I think if everybody's bullish, be a contrarian and look the other way. And then I think the unwind will be something to behold. I mean, I think, 2008 and 9 is not that far behind us. That it's not fresh in some people's minds anyway. I think this is going to be worse.
Well, as always, it's an absolute pleasure, chatting with you. I think the experience and the perspective you bring is really refreshing. It's enlightening to hear. So thank you very much for taking some time to share your wisdom with us. And obviously looking forward to chat with you again in the future. And for anybody that's interested, you can find David on Twitter. I'll throw the link to his profile in the video description below. There are a bunch of Dave imposters out there, so make sure you pay attention to the handle I give you, which will be the correct one. And unless there's anything else you got, pleasure chatting with you.
Yeah, let me just re-emphasize that, because thanks for mentioning that, because of late there have been, I think, probably a couple dozen imposters, and they just change one letter in it might be contrarian spelled wrong, or they add a letter, or they do something. Make sure you're at Dave H. Contrarian spelled correctly, because it is easy to get tripped up. The other thing is, I've got 165,000 followers. These imposters, typically you'll see they have hundreds of followers, or follow hundreds of people, not thousands. So you should be able to discern that. But I've seen enough people that will DM me and say, I heard from you. You told me you have a service on on Telegram, and I go, I'm not on Telegram. So these guys are trying to take your money. Be very aware that there are these guys out there trying to scam people. So as long as you keep your eyes open and look for Dave H. Contrarian, you shouldn't have any problem separating me out. But just, they have my profile picture, so it can fool you. It looks like it's me. It's not.
Yeah, thank you. And like I said, I'll make sure I get the obviously your right profile in there, so everybody should be good finding the way over to you. But otherwise, absolute pleasure. Thanks for chatting.
Okay, thanks, Eric. You take care.
Take care.